Welcome to the Cash Flow Project Podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
Welcome to the Cash Flow Project. I'm your host, Duke Ong with Tri-City Equity Group. With me is my co-host, Steve Fierros. Today we have Will Coleman on the show. Will began his real estate career in 2016 by investing in and self-managing single-family properties in the DFW market while working in property management for Greystar. In 2018, Will began working in commercial lending at Citibank as a credit analyst. Will now works as the director of Rand Capital, a mortgage brokerage which focuses on finding the ideal financing on apartments and mobile home parks. Will, welcome to the show.
Thanks, Duke. Steve, thanks for having me on. Excited to be here.
So how did you get started as a mortgage broker?
So I kind of had the bio introduced. I started working in commercial lending about 3 years ago, and I've always really loved debt. One of my favorite quotes is that debt is the circulatory system of the economy. So debt is really the blood flow of the economy, meaning almost every piece of property has debt on it, and how well the debt is structured and how well it's moving and how well it's being paid off really gives a testament to the blood flow of the economy. And I have kind of had that love affair for debt for a long time. And at the same time, have a love affair for investing. I was buying single family in DFW while working at a commercial real estate bank. And I joined Jake and Gino. I've got the shirt on in the background as well. So I joined their education program as a student to learn more about buying multifamily. And I got along quite well with Gino and Dylan and Mike and the team. And they had started a mortgage brokerage. And the more we talked, they kind of learned my experience in the commercial lending space. And they offered me, a position to partner with them on their mortgage brokerage. And that was about a year and a half ago or so. And now here we are and making it happen.
That's awesome. So what are the differences between residential financing and commercial financing?
Yeah, the biggest difference is that residential is much more based off you as a personal guarantor, so your personal income. So I guess there's two types of personal or residential lending: is if you're buying a property for yourself to live in, or if you're buying a single family investment property. So if you're buying a property to live in yourself, it's going to be very focused around your personal income. They want to see consistent W-2 income for at least 2 or 3 years. And they'll look at your debt to income ratio. It's very much more based off you as the borrower. It's really still the same if you're buying a single family investment property. They're going to look at the rental income and the DSCR on the property and the value and the loan to value, but it's still very much based off of your personal income. Like, for example, if you are an entrepreneur and you've got a ton of cash, but your income fluctuates quite a bit depending on how well your business does, it's going to be a lot more difficult, even if you make a significant amount more money than someone who makes $60,000 a year consistently. So it's kind of that the residential is going to look very specifically on your personal balance sheet and income, whereas commercial, they'll look at the property and say, okay, how much is the property cash flowing? How strong is the value of the property? How strong is the market of the property? And then they'll look at you as a personal borrower. So it's very much more focused on the actual property rather than you as a personal income. And a lot of real estate investors do it full time, so it's easier almost to do a commercial loan than it would be a residential in a lot of scenarios.
So for the commercial side, what are the pros and cons of using a mortgage broker as opposed to, say, going direct to a lender?
It's really just options, right? Like each lender is going to be very good at one thing. So for example, in the space that I play in, I broker mostly Fannie and Freddie. So this is debt on stabilized multifamily properties of $1 million or higher. Each lender is really, really good at one or two types of debt. So maybe it's Freddie Mac small balance. Maybe it's Fannie Mae conventional. Maybe they've got a really good private label product. They really are normally good at one or two options. And on top of that, they all have different income goals they need to meet. They all have different risk tolerances. So like, for example, maybe CBRE is behind on their income portfolio or their income targets that they need to meet, and they specialize in Freddie SBL. And so maybe for the next 2 quarters, they're saying, hey, look, we're going to give the best deals on Freddie SBL. Whereas if you only go directly to Bricadia, maybe they've hit their target at the beginning of the year. Like, we're not really going to need to be that competitive on Freddie Mac SBL loans. That's also not really what we specialize in. So by working with a mortgage broker, you can kind of have connections to 5 or 6 lenders all at once. So that way, when CBRE is really competitive on Freddie SBL, we can shift your deals that way. Or if CBRE kind of comes and says, hey, we're kind of full in our portfolio for smaller deals, we're really only shifting towards larger deals, then all of a sudden, okay, now you're looking at a deal, we can go and shift towards Bricadia rather than just consistently staying with the same lender. It's really just options and knowing who's doing what and always being able to keep people accountable. So that the lender that you always go to, maybe their rate has stayed the same, whereas a lot of the competition has gone down 20, 30 bips and they're doing slightly more leverage. So it's really just options.
Got it. That makes a lot of sense. So for our audience who's not so familiar with agency debt, could you just give us a quick primer?
Sure. So I'm kind of like I said, a debt nerd. So I'll start way in the beginning. So back in the Great Depression, a lot of mortgages failed. A lot of banks failed. There was a lack of liquidity in the market. So the government created Fannie Mae for the purpose of buying loans from banks and buying loans in the secondary market in order to provide liquidity to these banks. And then these banks would then be able to provide more loans to borrowers and then basically spread the liquidity throughout the market. So Fannie Mac is a government-sponsored entity. It was originally solely the government, and they created and made it private. It's still very well connected to the government. And its goal is to provide liquidity for affordable housing nationwide. So what they do now, 80, 90 years later, is the same thing. They still provide debt and leverage and liquidity on affordable housing throughout the nation. And what makes them unique is it's guaranteed by the government. So it's non-recourse to the borrower. So let's say you go out and buy a 50-unit deal. Let's say it's $5 million purchase price. So the loan's going to be around $3.5 million or so. If you go to a local bank, they're going to want your personal guarantee, meaning that if you default on that loan, you are going to have to pay the bank $3.5 million, you and your partners, and they can go after your beautiful house that Duke's got behind him. They can go after your farm. They can go after your second and third cars. They can go after your personal assets. Whereas Fannie and Freddie debt is guaranteed by the government and it's considered non-recourse. So they will only if the loan defaults, they'll only take the property back, and then you can kind of wipe your hands clean with it. It's obviously not going to look good on your record, but it's not going to take away your personal assets, which once you get into those $5, $6, $7 million loans, you really don't want that on your personal balance sheet because of the risk if they do go bad.
Got it. Okay. So let's say an investor calls you and has a 70 unit under contract, looking to get started with financing. So assuming it's a value add play, what type of debt would you recommend and why?
The 70 unit, we said it's a $7 million purchase price. Just stick with the
Sure. Yeah. Just a sample.
Okay. So the loan's going to be around 5.5, maybe slightly more, maybe slightly less. I would say in that scenario, you've got 2 options. You've got your local bank or you've got a bridge debt product. So Fannie and Freddie, if it's a value add, I'm assuming that the occupancy is not considered stabilized, which would be 90% physically occupied for 90 days. If you're going on a value add property, chances are the occupancy is going to be below 90%. It's going to need some significant rehab to go into the property. So in that scenario, Fannie and Freddie is normally not the most competitive for value add properties. So it depends a lot on the property and the specifics of what you're trying to do. But in that scenario, a local bank is going to be pretty competitive. It's going to have 70, 75% loan to cost, which means that you can include some of the rehab into your loan. So you put the 25% down payment on the property. And then if your rehab budget is 200,000, they'll give you a loan of 75% of that. So it's considerably less out of pocket. And then that loan typically is going to be 5-year term, 25-year amortization. It's going to have maybe 1 year, 2 years of interest only, and a very minimal prepay. So you can go in, you can purchase the property, fix it up, get it to the occupancy that's required, and then that's when you would refinance into agency. So local bank is one option. The other option would be bridge financing. So there are types of non-recourse bridge debt that can come from specific bridge lenders, or they can come from the same lenders that do Fannie and Freddie. So CBRE, Berkadia, Capital One, these lenders do have bridge products. So one of them is called like a Ready for Freddie. I remember, Duke, we looked at one of y'all's properties in El Paso for this potential product. And it's the same lender that administers the Freddie Mac loan that would administer the bridge product. And so the nice part of that is they see the building as it's transforming, and they know exactly when it's ready to switch into the non-recourse or into the Freddie Mac loan. However, when COVID hit, all the bridge lenders disappeared. There's too much risk in the market. They are not interested in taking that level of risk. We're seeing those lenders come back at much more force now, but from like March to August or so, those bridge lenders were gone. I mean, we witnessed it firsthand with y'all's property where the bridge product, as like, we're going to pass on this. Where a month ago they were very excited about it. So those are kind of your two top options for a value add. Once you get into the larger products, so like where your loan amount is $6, $7, $8 million, you can actually do a Fannie Freddie loan, which will include the rehab into the cost. So it's still got to qualify on the 90% of physical occupancy, but you can include some of those rehab costs into the loan, which is nice. So if you've got maybe you've got a stabilized property that is just below market in rents. So you can go straight into the Freddie Mac terms of 3% interest rate, 30-year amortization, 10-year term, 2-3 years interest only, and then include $5,000 to $6,000 per door in rehab that you can go in and turn the units and do value add that way. So there's a lot of different routes to go for it, but generally the local bank is probably the most competitive on deals kind of under that $6-7 million range.
Yeah, and that's exactly our playbook, is to go local and then into agency later. So
yep, yeah, and that's what Jake and Gino do as well.
All right. So what are you currently seeing in the market for like both the agency and non-agency lenders? In terms of rates, in terms of, you kind of hinted at like bridge is kind of a lot higher now. So
yeah, so we'll start with Fannie and Freddie. The terms are still really, really good. I mean, they're probably some of the best terms ever. The downside is there's two downsides. One is they're only lending to more experienced borrowers. So because there's more risk in the environment, obviously we're in a COVID scenario. They don't want to lend to newer borrowers. So they're much more selective on who they lend to. There's increased experience qualifications. There's increased experience is really the big one. They really want to see that you've got 2 or 3 years of experience managing a property. And the obvious other one is the COVID reserves. So if you're okay with the COVID reserves and you've got the experience piece, right now Fannie and Freddie have probably the best terms ever. So it's 70 to 80% loan to value, depending on the market and the deal. Probably on average right now, it's 75% loan to value. Interest rates are around 3% on the larger deals and around 3.5% on the smaller deals. 10-year term, 2 to 3 years interest only, 30-year amortization, and non-recourse. So it's some of the lowest rates. You still get the 30-year amortization, non-recourse, and you can fix an interest rate for 10, 12 years. So if we go into a rising interest rate environment over the next 3-4 years, if you've got a rate that's fixed at 2.9%, you feel fine as those rates are going up and up. So being able to fix your rate at these low rates and still get the leverage and the 30-year amortization. The terms are phenomenal. You just have to qualify as a borrower. On the local bank side, it's still very, very competitive. I mean, the majority of them are not asking for reserves. Some are. The majority are not. You're still seeing 70, 75% loan to value or potentially loan to cost. The amortization is, I would shoot for 25-year amortization. A lot of banks right now are trying to push for 20-year. And the reason for that is the shorter the amortization, the more principal you have to pay down. And so a year from now, the lower their loan amount is and the less risk they're taking. So a lot of have adjusted to try and push for 20-year amortization. If I were a borrower, I would fight like hell to get a 25-year amortization. And if they try and threaten a 20, just say, no, I'll go somewhere else. And then from a bank, the interest rates are really good. I mean, probably around 4%. I think Duke, you guys have seen some below that. I mean, the rates of banks are phenomenal. You can still get a lot of your rehab into the loan. It's definitely a competitive environment for banks right now. The same thought of they're wanting to lend to more experienced borrowers. So we're definitely in a situation where the newer borrower, it's going to be much more difficult to get loans. And a lot of people I talk to, I always recommend trying to partner with someone and give up a little bit of that equity. It's going to help you out so much more on the lending terms, because if you're a new borrower and you're trying to buy a 10-unit deal, if you've got a net worth of $300,000-$400,000, you've got $80K in your bank, you're probably just not going to get a loan. Unfortunately, you really need to have if you have no experience, if you've got a borrower that's got the same net worth with 5-6 years of experience, it's a piece of cake. So it's that experience piece is going to be, if anyone takes anything from this podcast, find a partner with experience or find a way to amplify your experience, because that's what lenders are going to focus on right now.
So you mentioned earlier about interest reserves. I know it's not so cut and dry. So can you expound on the subtleties of that, like from the agency side?
Yeah, it actually is very cut and dry. Depending on the loan amount will specifically determine what the principal and interest reserves are. So Freddie Mac, they're to kind of give context in March when all this hit, rather than pulling out of the market and say, we're not going to lend, what Fannie and Freddie did is said, we will still continue to lend, but you have to take X amount of dollars and put them in a reserve account in case things go bad. So they're calling them principal and interest reserves or COVID reserves. I get tired of everyone calling them different things. But the Freddie Mac, if it's a small balance loan, so like around less than 6 million or so, it's going to be 12 months of principal and interest reserve. If it's a conventional loan, so greater than 6 million, it's going to be either 6 or 9 months principal and interest reserve. If it's Fannie Mae, if it's a small balance loan, so like less than 7.5 million, it's going to be 18 months of principal and interest. And if it's a small balance loan with Fannie Mae, it's going to be 12 months of principal and interest. So that's kind of the boxes that you can see. Freddie Mac's slightly more competitive when it comes to the reserves for sure.
Oh, that's great information. That's going to lead me into my question was, in terms of, hey, what are some things operators and just investors need to know before, coming to you and say, hey, Will, this is what I've got. This is the deal that I've got on the table. Like, what's going to make them the most competitive in terms of like streamlining the process, so they're not having to start from step one or from behind.
Sure. Yeah. I would say the having your documents prepared is probably the biggest thing. So having your personal financial statement prepared, having your tax returns if you're going to a community bank, having your business plan prepared, having your bios and summary of who the borrowers are and their experience, having all of that prepared and documented. The first time you speak with myself or with another lender, you can say whatever you want over the phone, but as soon as you send those documents over and you can verify your experience as well as your net worth and liquidity, that's going to give you a significant advantage of, winning over the lenders, because I'm sure it's slightly more difficult to get lenders on the phone right now. But winning over lenders, getting them to take you seriously, getting better terms, having your personal financial statement, your tax returns, your bios, your business plan, having all of that prepared is going to help you out quite a bit.
And it sounds like too, you mentioned earlier that, okay, the lenders right now are being much more selective in terms of, let's say, experience, right? Like you really need to kind of put yourself standing out from the crowd, right? That's a great way to do it. It's like, okay, yeah, I've got everything ready. That definitely shows that you're experienced. So I would imagine they're that much more likely to want to work with you, right?
Yeah, and it shows you're taking it seriously too. It's like you've taken the time to build these documents, to prepare. It's a sign of how it will be working with you in the future. So having clean, well taken care of documents, or maybe potentially having a website. I mean, I've seen y'all's Tri-City website and advertising. It's phenomenal. So anyone who's listening, copy what you guys do.
Appreciate the vote of confidence there and the kudos there.
Yeah.
I love what you kind of started off with earlier and just kind of sharing like your experience and getting into the lending game. It's like, you gotta have to have a love affair with debt. And it's like, oh, okay. Like it's not often that you hear that, right? Like most of the time it's like, it's the other way, right? It's no, people do have a love affair with debt, but to their detriment versus, to their benefit, right?
Leverage is one of the most powerful tools in the financial industry, and it can really hurt you or it can really help you.
Yeah, no, for sure. And I think that's and even just seeing, kind of to your point about, okay, well, the lenders are being much more selective right now. They really want experience. It's like, okay, well, the first thing that came to my mind, of course, hearing that, and, obviously we're going through turmoil right now, but my mind going into this, having been through a market cycle before, through the last downturn, it's like, okay, you know what, fortunes are going to be made during this time. And, this is, I know we hear a lot about it in the media, the rich get richer, the poor get poorer. And it's like, yeah, but there's a reason for that. It's like, okay, being able to see the opportunity, being prepared during times like this. And just like how you mentioned, okay, well, hey, the lenders are going to go with people with experience. Okay, well, it's not like you can just get experience right now when you need it. This is something that you have to have been working on, developing that, that track record, building up, being in a spot where, okay, hey, downturn right now, like, okay, we're going to go after some stuff.
Yep. Yeah. And it's, that's one of the reasons that the rich get richer and the poor get poorer is, capitalism has it has ebbs and flows. It has up cycles and down cycles. And during the up cycle, it slowly lifts everyone up. And then during the down cycle, the people that, weren't, they were too risky and took too many risks, and they weren't, as conservative, as smart as they should have been. When on the down cycle, those people are going to lose their assets, and the people that were smart and were able to withhold from the shiny object syndrome and just throwing money at things that they thought were going to, make a ton of money. Those people during a down cycle can then go and pick up the assets that the people that couldn't prepare for at a cheaper price, and it builds and builds and builds. And it's one of the pros and cons of capitalism, and it does lead to income inequality. But the rules are the same for everyone. You can either be one of the people that prepares or doesn't. And then the second piece of what you said, the experience piece, lending is very much, investing in real estate in general is very much a relationship business. So even if you don't, during an upcycle, even if you don't have a ton of experience, even if you don't, maybe you're younger or maybe you are newer to the space, you still want to build those relationships with lenders. And, let's say, now it's 2020 and 2017, 2018, 2019. And that way, those lenders know who you are. They've seen you over the years. And then when the down cycle does come and you show up at their door, they're like, oh yeah, I've known you for 3-4 years now, rather than, now I want to start buying assets that the market is bad. And you're like, well, I don't even know who you are. I don't know if I can trust you. So focusing on building strong relationships at all times during a down cycle is when you can benefit from a crash, because the crash will always come. It's, you need to prepare for it. And there's a myriad of ways you can do that. But one of those ways is building relationship with lenders, whether it's local banks, whether it's Fannie and Freddie lenders, whether it's a mortgage broker. Building those relationships at all periods of the cycle is how you prepare for the downturn.
So with that said, question, or to the benefit of our listeners, what's the best way for them to build that relationship, let's say, with you?
I mean, just call me. I mean, obviously, the better educated you are and the more you know and the more you can speak the language of a real estate investor, the better. And just communicating with lenders, reaching out to them, and maybe you're not active currently, and say, hey, I'm not looking to buy now. I'm looking to buy a year from now, but I wanted to reach out, introduce myself, pick your brain on a couple questions. Can I take you out for a cup of coffee? Can I buy you lunch? What events are you going to in the future? Any lender is going to be willing to spend 10, 15 minutes on the phone with a buyer who's planning to buy a year from now, and just say, hey, what can I do to be prepared a year from now? So that way, when, let's say you do that in 2019, and you call them back in 2020 when the market has crashed, and say, hey, remember I talked to you a year ago, you told me to do this, I've done it, now I'm ready to buy some deals. Even that little bit would help. So it's really just, being prepared, calling lenders, and networking.
That's great advice. So, to any of our listeners there that are kind of on the fence, or, wanting to, take the dive into multifamily and wanting to do it on their own versus, going through a syndication or something. Great advice right there. You reach out to Will or whoever, if you've got a lender in the industry, of course, and just kind of make that contact. They don't think, okay, well, I can't go to them until I actually need a loan. It's like, okay, start establishing that relationship, start building some rapport. So kind of just to switch gears a little bit, you've obviously been in the industry, several years. You've got quite a bit of experience now at this point. Tell us a little bit of the most eventful transaction that you've had. This could be, this is kind of just a little bit more for fun, but it could be on the residential side, could be on the commercial side. Some experiences.
As I'm sure you guys too, I've got way too many stories to pick from. I guess the one I'd pick would be a loan that happened recently that we had we got under application the day of Corona, like the day that Tom Hanks got Corona. Remember that was the day that just everything dropped. Like March, middle of March.
I like that how that's the mile marker, right?
That's what I think of, honestly. But that day, I remember I was actually at Jake, our principal, Jake Stenziano's house. I can never say his last name, Stenziano. And we're shooting videos, and the whole market was crashing. We felt like the world was going to end. And we were working on getting this loan under application, and my borrowers called me. So I'm literally in Jake's office talking to them. And they're like, do we do this? What do we do? And I'm like, look, I think you need to get under application now if you want to get this thing done. We don't know what the next couple of weeks are going to look like. And luckily we got under application that day. And the next couple of weeks, the interest rates shot up quite a bit. So we're able to get a more competitive interest rate, just because when there's more risk, a lot of times the interest rates will go up. And then a couple of weeks later, they drop down. So it would have been null. But so it started with Corona. And then a couple weeks later, there was a murder-suicide on the property, which, and this is with Freddie Mac, and Freddie Mac is very controlled. Like, they don't take a lot of risks. And so there was murder-suicide, and it looked horrible. And so we had to build a whole plan around what happened. We called the local sheriffs, got a full story. We had the borrowers install like security cameras. We had them install security cameras. We had them increase the amount of patrolling that was going on. We called other residents on the property and said, hey, can you write a letter saying that you love living here, that the area, the property is safe. Like, this was just a one-off incident. Like, we had to show all the background checks of the incident that happened. So we built this whole plan, submitted to Freddie Mac, and they finally approved it. And then the lender that was working on the property, he was like, I've never seen us get something like this approved, like in the midst of COVID and then a murder suicide. And we had to fight like hell to get it done. And we were able to get approved and move forward. But that was one that, that happened 4 or 5 months ago. And that was hectic. Like when we heard about the murder suicide, the lender was just kind of like, this is going to be tough. And we did our best and we got to push through.
That's awesome. Yeah, that's definitely probably one of the more wilder ones that I think I've heard. So kudos to you guys, you and the team for pushing that through.
Yeah, we were happy to get it done.
I'm sure the borrowers were too. They're probably thinking like, crap, like what are we gonna do now?
Yeah.
And that reminds me of that reality distortion feel that Steve Jobs had. Like it just like bend reality to his will, right? Like no matter what, like the circumstances are, it's just like will happen by this deadline. Like
that's very Steve Jobs-esque. I can just imagine.
But all right. So as we transition to our fire round, what is the best book that you recommend other than Rich Dad, Poor Dad?
The best book. I mean, can I give two?
Sure.
I would say Atlas Shrugged. I mean, our company is Rand, Rand Commercial Real Estate, based off the author Ayn Rand. So Atlas Shrugged is probably one of the most influential books that I've ever read. And then second one, I would call it The One Thing, which actually me and Vince were talking about it the other day. It's a book that reminds you that majority of your output will come from doing one thing. So if you can just focus on that one thing and not let everything else bother you, then you'll be much more successful. And I read that every year as a reminder.
Definitely excellent books. What is your superpower?
I'm a thinker, man. I even small problems I'll spend hours thinking about. So it's my blessing and curse.
And what is the biggest lesson you've learned over your career?
Whenever you experience failure, that to look at that as a opportunity to improve. So anytime you fail, reflect on it, and rather than make you think negatively about it, say, okay, why did I fail? How can I prevent that from happening? And almost be excited for failure, because that's going to lead to a principle that you can use for future success.
Yeah, the obstacle is the way.
Dude, I love that. Ryan Holiday, come on.
So for the busy working professional who's working towards financial freedom, what advice do you have?
Probably surround yourself towards people who have done it. Yeah, they'll have tips, they'll have tricks, they'll have lessons. They can hold your hand through it, even if they're not doing it directly. They'll indirectly, you can follow their lead. All
right. So thank you so much for your time. How can our audience get a hold of you?
Yeah, so my email is will@randcre.com. That's definitely the best way, will@randcre.com. And then we have a personal financial statement template. So anyone who's trying to get a loan, you need to fill out your personal financial statement. If you go to randcre.com/PFS, you can download a free copy. We built it. It's specifically for commercial real estate lending. It's we got it based. It's based off Freddie Mac template. So it's the best personal financial statement template I've ever seen. I've worked in commercial lending now for like 4 years. So randcre.com/PFS, and you can get a free copy of that there.
Awesome. Thank you for sharing that.
Of course.
Wow, what an awesome show, Duke. Having Will on from Rand Capital to come on and share kind of the current state of lending on the commercial side. So, great having him on the show. It's a wealth of knowledge. I think you guys really enjoy the show on this one. So, some of the things that he touched on, I actually love the way that he opens up and kind of his, what started him down the path of lending was just, having a love affair with debt. Too often we see people having a negative association with debt. That's what you hear, Dave Ramsey and all these kind of guys. And for the most people, I think that that's true. For an investor, though, you're going to have a love affair with debt, a healthy one at that. But, I think that's a great quote, that he gave. So he gave us a, kind of a snapshot, kind of what to look for both in residential terms, on the lending side versus commercial terms, how the residential is much more personally, since it's personally guaranteed, they're looking much more at your personal finances versus commercial. They're more concerned about, hey, what's the deal look like? It's effectively a business. So, what are the market drivers that are affecting that property? How's the property itself? How does the deal look? So that's much more important. Of course, your personal finances and all that kind of stuff can come into play as well, and they do, especially on the smaller deals, but something to keep in mind. He also broke down for us the differences between, hey, going with a mortgage broker versus direct lender. As he's kind of going along, I'm thinking of, going with a broker gives you a variety of options. You have a buffet of lending options because each one of the lenders may specialize in a certain type of product. And they also have their own in-house portfolio of lending that they can take on. So going with a broker, they can shop different lenders. They kind of know, they keep their pulse on what's going on with the current lending environment and with each one of these lenders. So some may be a little bit more aggressive at certain moments throughout the year, maybe give you some better options, give you some better terms. So that was actually super helpful. And gave us a quick snapshot of kind of the current lending terms to expect to find right now. He makes a point to make sure, if you're dealing with, local community bank, hey, make sure that you're pushing for the higher amortization. They may be trying to push back with 20% or 20 year AM right now. Make sure that you're pushing back for, fighting hard for a 25-year AM. And then he gave us a couple of great book recommendations. Atlas Shrugged, I know it's a very popular one. And The One Thing, making sure you're focusing on what gives you the highest return. And that's kind of what the book covers. What gives you the highest return for, your efforts. So that's a great book recommendation. And then one last great recommendation he gave. This will help to get you started in terms of getting ready for your lender. Going to randcapital.com and then downloading the PFS that they actually have put together that will help to get your, what kind of information that they need, your personal financial statement, making sure that you have all of that information on hand, ready to go to give to the lender. It's going to show that you're prepared and ready to take the next step.
And if you're interested in connecting with us, go to tricityequity.com to learn more. To connect with like-minded investors, join our Facebook group, Honolulu Multifamily and More. If you found value in this podcast, please subscribe and give us a review on Apple Podcasts or Spotify. If you know anyone who might resonate with today's podcast, please share the episode with them. See you next time.